Did you know that the wealthiest 10% of the world's population owns 90% of the global wealth? This staggering statistic highlights the importance of smart investing. In this video, you'll learn the fundamentals of investing, how to build a solid investment strategy, and avoid common mistakes that could cost you dearly. Understanding investment is more crucial than ever in 2024 due to market volatility and emerging opportunities. Let's dive in. What is investing? In this segment, we're diving into the basics. What is investing? At its core, investing is the act of allocating resources, typically money, with the expectation of generating an income or profit. This isn't just about buying stocks or bonds. It's a strategic way to grow your wealth over time. Think of investing as planting a tree. You plant a seed, nurture it, and over time, it grows into a sturdy tree that bears fruit. Similarly, when you invest money, you're planting a seed with the potential to grow your wealth. The main purpose is to achieve financial goals, such as buying a home, funding education, or securing a comfortable retirement. So, how does investing work? When you invest, you purchase assets that you believe will increase in value over time. These assets can be stocks, bonds, real estate, or other investment vehicles. The goal is for these assets to appreciate in value, providing you with a return on your investment. Additionally, some investments generate income, such as dividends from stocks or interest from bonds. 3. It's important to note that investing comes with risks. The value of your investments can fluctuate based on market conditions, economic factors, and the performance of the specific assets you hold. However, with careful planning and a solid strategy, investing can be a powerful tool to build wealth over the long term. 4. Now, you might be wondering, why should you invest instead of just saving your money? While saving is essential for short-term needs and emergency funds, it doesn't provide the same growth potential as investing. Inflation can erode the purchasing power of your savings over time. By investing, you can potentially earn returns that outpace inflation, helping your money grow and maintain its value. 5. Investing also offers the opportunity for compounding. Compounding is the process where the returns on your investments generate their own returns. For example, if you invest $1,000 and earn a 5% return, you'll have $1,050 at the end of the year. If you leave that money invested, the next year you'll earn a return on $1,050 and so on. Over time, compounding can significantly boost your wealth. 6. Another important aspect of investing is diversification. Diversification involves spreading your investments across different asset classes, industries, and geographic regions to reduce risk. The idea is that different investments will perform differently under various market conditions. By diversifying, you can mitigate the impact of a poor-performing investment on your overall portfolio. 7. So, what are the basic steps to start investing? First, define your financial goals. Determine what you want to achieve and the timeline for each goal. Next, assess your risk tolerance. Understand how much risk you're willing and able to take. Then, choose an investment strategy that aligns with your goals and risk tolerance. This could involve selecting individual stocks, bonds, mutual funds, or other investment vehicles. 8. It's also crucial to educate yourself about investing. Read books, take courses, and follow reputable financial news sources to stay informed. Consider working with a financial advisor who can provide personalized advice and help you develop a comprehensive investment plan. 9. In summary, investing is a powerful way to grow your wealth and achieve your financial goals. It involves purchasing assets that have the potential to increase in value over time and generate income. By understanding the basics of investing and taking a strategic approach, you can build a strong financial future. Different types of investments. Now, let's explore the different types of investments you can consider. Each type has its own characteristics, benefits, and risks. Understanding these can help you make informed decisions and build a diversified portfolio. First up, we have stocks. When you buy a stock, you purchase a share of ownership in a company. Stocks offer the potential for high returns. As companies grow and become more profitable, the value of their stocks can increase. Additionally, some companies pay dividends, which are periodic payments to shareholders. However, stocks can be volatile, meaning their prices can fluctuate significantly over short periods. Next, we have bonds. Bonds are essentially loans you give to governments or corporations in exchange for regular interest payments and the return of the bond's face value at maturity. They are generally considered safer than stocks, but typically offer lower returns. Bonds can be a good option for investors looking for stable, predictable income. Real estate is another popular investment type. This involves purchasing property to generate rental income or to sell at a higher price in the future. Real estate can provide steady income and the potential for appreciation. However, it requires significant capital and management effort, such as maintaining the property and dealing with tenants. Mutual funds and exchange-traded funds, or ETFs, are pooled investment vehicles that allow you to invest in a diversified portfolio of assets managed by professionals. Mutual funds are bought and sold at the end of the trading day at their net asset value, while ETFs trade like stocks on an exchange throughout the day. These funds offer diversification and professional management, which can reduce risk and simplify the investment process. Commodities include physical goods like gold, oil, and agricultural products. These investments can provide a hedge against inflation and add a diversification to your portfolio. Commodity prices can be volatile, influenced by supply and demand dynamics and geopolitical events. 6. Lastly, cryptocurrencies have gained popularity in recent years. These are digital or virtual currencies that use cryptography for security and operate independently of a central bank. Bitcoin, Ethereum, and other cryptocurrencies offer high potential returns, but come with significant volatility and regulatory risks. Cryptocurrencies are a newer, more speculative investment compared to traditional assets. 7. Each type of investment has its own risk-return profile, and it's essential to understand these before committing your money. Stocks can offer high returns but come with higher volatility. Bonds provide more stable returns but typically at a lower rate. Real estate can generate steady income but requires more management effort. Mutual funds and ETFs offer diversification and professional management. Commodities can hedge against inflation but can be volatile. Cryptocurrencies offer high potential returns but come with significant risks. A well-diversified portfolio often includes a mix of these different types of investments, tailored to your financial goals and risk tolerance. By spreading your investments across various asset classes, you can reduce the impact of a poor-performing investment on your overall portfolio and increase the potential for long-term growth. Risk versus reward concept. Now let's talk about the risk versus reward concept, a fundamental principle in investing. Simply put, this concept refers to the trade-off between the potential risks an investment carries and the potential rewards it can provide. Higher potential returns usually come with higher risks. Let's break down some examples of risk. Market risk is the possibility that the entire market will decline, affecting the value of your investments. Credit risk is the chance that a bond issuer will default on interest payments or fail to repay the principal. Liquidity risk is the risk that you won't be able to sell your investment quickly without affecting its price. Inflation risk is the danger that inflation will erode the purchasing power of your returns. On the reward side, capital gains are profits from selling an asset for more than its purchase price. Dividends are regular payments made by a company to its shareholders from its profits. Interest is earnings from bonds or other fixed income investments. Rental income is money earned from renting out real estate properties. Balancing risk and reward is crucial for successful investing. Diversification is a key strategy for managing risk. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the impact of a poor-performing investment on your overall portfolio. Asset allocation is another important strategy. This involves dividing your portfolio among various types of investments to balance risk and reward based on your financial goals, risk tolerance, and investment horizon. Understanding your risk tolerance is essential. Risk tolerance is your ability and willingness to endure market fluctuations without panic selling. It's influenced by factors such as your financial situation, investment time horizon, and personal comfort with risk. Assessing your risk tolerance can help you make informed decisions and build a portfolio that aligns with your financial objectives. In summary, the risk versus reward concept is about understanding the potential risks and rewards associated with different investments and finding a balance that suits your financial goals and risk tolerance. By diversifying your investments and carefully considering your asset allocation, you can manage risk and work towards achieving your long-term financial goals. 6. One of the best ways to manage risk is through diversification. This means spreading your investments across various asset classes, sectors, and geographic regions to reduce the impact of any single investment's poor performance on your overall portfolio. For example, if one of your stocks underperforms, your other investments in bonds, real estate, or other sectors might help balance out the loss. Diversification can help smooth out the ups and downs of the market, providing a more stable return over time. 7. Another key strategy is asset allocation, which involves dividing your investments among different asset classes such as stocks, bonds, and cash. The right asset allocation depends on your financial goals, risk tolerance, and investment horizon. For example, younger investors with a longer time horizon might allocate more to stocks for growth potential, while older investors nearing retirement might prefer a higher allocation to bonds for stability and income. 8. It's also important to regularly review and adjust your investments to ensure they remain aligned with your goals and risk tolerance. Market conditions and personal circumstances can change, so it's crucial to stay proactive in managing your portfolio. Rebalancing your portfolio periodically can help maintain your desired asset allocation and manage risk. How stock markets work. In this segment, we'll delve into how stock markets work. At their core, stock markets are platforms where buyers and sellers trade shares of publicly listed companies. These markets facilitate the buying and selling of stocks, bonds, and other securities, providing companies with capital to grow and investors with opportunities to earn returns. The stock market operates through exchanges, such as the New York Stock Exchange, NYSE, and NASDAQ. These exchanges act as intermediaries, ensuring transactions are conducted efficiently and transparently. Companies list their shares on these exchanges through an initial public offering, IPO, allowing the public to buy and sell their stocks. There are two main types of stock markets, primary and secondary. In the primary market, new securities are issued and sold to investors for the first time, typically through IPOs. Here, companies raise capital by selling shares directly to investors. Once these shares are issued, they are traded in the secondary market, where existing securities are bought and sold among investors. This is where the majority of stock market activity occurs. To trade stocks, investors place orders through brokers. There are different types of orders you can place, including market orders, limit orders, and stop orders. A market order is an order to buy or sell a stock immediately at the current market price. A limit order is an order to buy or sell a stock at a specific price or better. A stop order is an order to buy or sell a stock once it reaches a certain price. Understanding these order types helps investors execute trades effectively based on their strategies. Market participants include retail investors, institutional investors, market makers, and brokers. Retail investors are individual investors who buy and sell securities for their personal accounts. Institutional investors are entities such as mutual funds, pension funds, and insurance companies that invest large sums of money. Market makers are firms or individuals that provide liquidity to the market by buying and selling securities at publicly quoted prices. Brokers act as intermediaries, executing buy and sell orders on behalf of investors. Stock prices are determined by supply and demand. When more people want to buy a stock than sell it, the price goes up and vice versa. Factors influencing supply and demand include company performance, economic conditions, market sentiment, and geopolitical events. For instance, if a company reports strong earnings, demand for its stock might increase, driving up the price. Conversely, if there's negative news or poor economic data, the stock price might decline. Economic factors affecting investments. Understanding the economic factors that affect investments is essential for making informed decisions. Let's dive into some of the key factors that can influence the performance of your investments. First, we have interest rates. Central banks, like the Federal Reserve in the United States, set interest rates to influence economic activity. Lower interest rates generally stimulate borrowing and spending, which can boost economic growth. This often leads to higher corporate earnings and, consequently, rising stock prices. On the other hand, higher interest rates can slow down borrowing and spending, potentially leading to lower corporate earnings and declining stock prices. Inflation is another crucial factor. Inflation measures the rate at which the general level of prices for goods and services is rising. Moderate inflation can indicate a growing economy, but high inflation erodes purchasing power and can harm investment returns. When inflation is high, central banks may raise interest rates to cool down the economy, which can negatively impact stock and bond prices. Conversely, low inflation might lead to lower interest rates, benefiting stocks and bonds. Employment data is a key economic indicator. High employment rates and job growth figures typically signal a healthy economy, leading to increased consumer spending and business investment. This can positively impact corporate earnings and stock prices. Conversely, rising unemployment rates may indicate economic trouble, leading to lower consumer spending, reduced business investment, and declining stock prices. Gross domestic product, GDP, is another vital indicator. GDP measures the total value of goods and services produced in a country. It's a broad indicator of economic performance and growth. Strong GDP growth usually benefits corporate profits and stock prices, while weak GDP growth can signal economic slowdown and negatively impact investments. Fiscal policies, such as government taxation and spending, also play a significant role. Tax cuts can increase disposable income for consumers and boost business profits, potentially driving up stock prices. Increased government spending can stimulate economic growth, benefiting corporate earnings and investments. On the other hand, higher taxes and reduced government spending can slow down economic activity, negatively affecting investments. Geopolitical events can significantly impact the financial markets. Political stability, international trade relations, and conflicts can influence market conditions. For example, trade tensions between major economies can lead to market volatility and affect stock prices. Political stability in a country can attract foreign investment, boosting the local stock market, while political instability can deter investment and negatively impact market performance. Currency exchange rates can also affect investments, especially for international investors. Changes in exchange rates can impact the value of investments in foreign markets. For instance, a stronger domestic currency can reduce the value of foreign investments when converted back to the domestic currency and vice versa. Bull versus bear markets. Now let's discuss the concepts of bull and bear markets, two fundamental terms in the world of investing. Understanding these market conditions can help you navigate the financial markets more effectively. A bull market is a period when stock prices are rising or are expected to rise. It's characterized by investor optimism, increased buying activity, and general economic growth. During a bull market, confidence in the economy and corporate earnings is high, driving up demand for stocks and pushing prices higher. Bull markets can last for months or even years, and they often coincide with periods of strong economic performance and low unemployment rates. Conversely, a bear market is a period when stock prices are falling or are expected to fall. It's characterized by investor pessimism, increased selling activity, and economic slowdown. In a bear market, confidence in the economy and corporate earnings is low, leading to reduced demand for stocks and declining prices. Bear markets can also last for extended periods and often coincide with economic recessions, high unemployment rates, and decreased consumer spending. So, how can you identify a bull or bear market? One way is to look at market indexes, such as the S&P 500, Dow Jones Industrial Average, or NASDAQ. A sustained increase in these indexes indicates a bull market, while a sustained decrease indicates a bear market. Generally, a 20% rise or fall in a market index from its recent peak or trough is considered the start of a bull or bear market, respectively. It's important to note that markets don't move in a straight line. Even during bull markets, there can be short-term corrections where prices temporarily decline. Similarly, during bear markets, there can be short-term rallies where prices temporarily increase. Understanding the overall trend and market sentiment is key to navigating these fluctuations. Investing strategies can vary depending on whether you're in a bull or bear market. During a bull market, investors might focus on growth stocks, which are expected to grow faster than the overall market. These stocks often provide higher returns but come with higher volatility. Additionally, investors might increase their exposure to equities to capitalize on rising prices. It's also a good time to review your portfolio and ensure it's well diversified to manage risk. In a bear market, investors might shift their focus to defensive stocks, such as utilities and consumer staples, which tend to be less affected by economic downturns. Increasing allocation to fixed income investments like bonds can provide stability and income during periods of market volatility. Another strategy is to use dollar cost averaging, which involves investing a fixed amount of money at regular intervals. This approach can help mitigate the impact of market fluctuations and reduce the risk of making poor investment decisions based on short-term market movements. It's crucial to avoid panic selling during bear markets. Selling your investments out of fear can lock in losses and prevent you from benefiting from eventual market recoveries. Instead, maintain a long-term perspective and stay focused on your financial goals. Bear markets can present buying opportunities, as quality stocks may be undervalued and available at lower prices. Building your investment strategy, assessing your financial goals and risk tolerance. 2030, 2345. In this segment, we're going to talk about building your investment strategy, starting with assessing your financial goals and risk tolerance. These are the foundational steps that will guide all your investment decisions. First, let's define your financial goals. Financial goals are the objectives you want to achieve with your investments. These can be short-term, medium-term, or long-term. Short-term goals might include saving for a vacation or an emergency fund, typically within 1 to 3 years. Medium-term goals could be buying a house or funding a child's education, usually within 3 to 10 years. Long-term goals often involve retirement planning, generally over 10 years or more. To set effective financial goals, be specific about what you want to achieve and by when. For example, instead of saying, "I want to save for retirement," specify, "I want to save $1 million for retirement by age 65. This clarity helps you create a concrete plan and measure your progress. Next, let's talk about risk tolerance. Risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. It's influenced by factors such as your financial situation, investment time horizon, and personal comfort with risk. There are three main levels of risk tolerance: conservative, moderate, and aggressive. Conservative investors prioritize preserving their capital and are willing to accept lower returns to minimize risk. They typically have a shorter investment horizon or a lower capacity to absorb losses. Moderate investors seek a balance between risk and return. They're comfortable with some level of volatility in exchange for moderate returns. Aggressive investors are willing to take on higher risk for the potential of higher returns. They usually have a longer investment horizon and can withstand significant market fluctuations. To assess your risk tolerance, consider using risk assessment questionnaires available from financial advisors or investment platforms. These questionnaires ask about your investment goals, time horizon, financial situation, and reactions to hypothetical market scenarios. The results can help you understand your risk tolerance and guide your investment strategy. Balancing your financial goals with your risk tolerance is crucial. If you have a long-term goal, such as retirement and a high-risk tolerance, you might allocate more to stocks, which have higher growth potential but also higher volatility. Conversely, if you have a short-term goal like saving for a down payment on a house and a low-risk tolerance, you might prefer more stable investments like bonds or money market funds. Once you've assessed your financial goals and risk tolerance, you can start developing your investment strategy. This involves selecting the right mix of assets to achieve your goals while staying within your risk comfort zone. Remember, your strategy should be dynamic and adaptable to changes in your life circumstances or financial markets. Importance of diversification. Now, let's discuss the importance of diversification in your investment strategy. Diversification involves spreading your investments across various asset classes, sectors, and geographic regions to reduce risk. The idea is that different investments will perform differently under various market conditions, helping to balance your overall portfolio performance. Think of diversification as not putting all your eggs in one basket. If you invest all your money in a single stock and that company faces financial difficulties, you risk losing a significant portion of your investment. However, if you spread your investments across multiple stocks, bonds, real estate, and other asset classes, the poor performance of one investment is less likely to severely impact your entire portfolio. There are several types of diversification to consider. First, there's asset class diversification. This means investing in different types of assets, such as stocks, bonds, real estate, commodities, and cash. Each asset class has its own risk and return characteristics. For example, stocks typically offer higher returns but come with higher volatility. Bonds provide more stable returns but at a lower rate. Real estate can generate steady income and depreciation, but requires more management effort. Next, there's sector diversification. Within the stock market, different sectors can perform differently based on economic conditions. For instance, technology stocks might thrive during periods of innovation and growth, while consumer staples might perform better during economic downturns. By investing in a variety of sectors, you can reduce the impact of sector-specific risks on your portfolio. Geographic diversification is another important aspect. Investing in different geographic regions can help mitigate the risk of economic or political issues in any single country. For example, while one country might be experiencing a recession, another might be in a period of economic growth. By investing globally, you can benefit from growth opportunities in various regions and reduce the risk associated with investing solely in your home country. Diversification also includes temporal diversification, which involves spreading your investments over time. This strategy, known as dollar cost averaging, involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can reduce the impact of market volatility and help you avoid the pitfalls of trying to time the market. One common mistake investors make is thinking that diversification means owning many investments. True diversification involves owning investments that respond differently to the same market events. For example, owning multiple tech stocks is not as diversified as owning stocks from different sectors like technology, healthcare, finance, and consumer goods. A well-diversified portfolio can help you achieve a smoother ride in the investment world. It can reduce the impact of any single investment's poor performance on your overall portfolio and increase the potential for steady long-term growth. Diversification does not eliminate risk entirely. but it is a powerful tool to manage and reduce it. Asset allocation strategies. Now let's talk about asset allocation strategies, a critical aspect of building a successful investment portfolio. Asset allocation involves dividing your investment portfolio among different asset categories such as stocks, bonds, and cash. The right mix depends on your financial goals, risk tolerance, and investment horizon. There are several asset allocation strategies to consider. First, there's strategic asset allocation. This long-term approach involves setting target allocations for each asset class and periodically rebalancing your portfolio to maintain these targets. For example, you might decide to allocate 60% of your portfolio to stocks, 30% to bonds, and 10% to cash. Over time, as market conditions change, you'll need to rebalance your portfolio to ensure it stays aligned with your target allocations. Tactical asset allocation is a more active approach. It involves adjusting your asset allocation based on short-term market conditions and economic outlooks. For instance, if you anticipate strong economic growth, you might temporarily increase your allocation to stocks to capitalize on potential gains. Conversely, if you expect a market downturn, you might shift more assets into bonds or cash for stability. Tactical asset allocation requires regular monitoring of the markets and a willingness to make adjustments based on market trends. Dynamic asset allocation is similar to tactical asset allocation, but involves continuous adjustments to your asset mix as market conditions change and as you progress toward your financial goals. This strategy is highly flexible and responsive to market movements. For example, as you near retirement, you might gradually shift your portfolio from stocks to bonds to reduce risk and preserve capital. A common rule of thumb for asset allocation is the 100 minus age rule. This rule suggests that you subtract your age from 100 to determine the percentage of your portfolio that should be invested in stocks. The remaining percentage should be allocated to bonds and cash. For example, if you're 30 years old, the rule suggests allocating 70% to stocks and 30% to bonds and cash. This rule provides a starting point, but you should adjust your allocation based on your specific goals and risk tolerance. Another important aspect of asset allocation is considering your investment time horizon. If you have a long-term horizon, such as 20 years or more until retirement, you can afford to take on more risk with a higher allocation to stocks. Stocks offer higher growth potential over the long term, but come with higher volatility. Conversely, if you have a short-term horizon, such as saving for a down payment on a house in 5 years, you might prefer a more conservative allocation with a higher proportion of bonds and cash. Rebalancing your portfolio is a key component of maintaining your asset allocation strategy. Over time, the performance of different asset classes can cause your portfolio to drift from its target allocation. For example, if stocks perform exceptionally well, they might grow to represent a larger percentage of your portfolio than you intended. Rebalancing involves selling some of the outperforming assets and buying more of the underperforming ones to restore your original allocation. This process helps you manage risk and ensures your portfolio stays aligned with your goals. It's also important to consider tax implications when making asset allocation decisions. Certain investments, such as stocks held for over a year, may qualify for lower long-term capital gains tax rates. Tax-advantaged accounts like IRAs and 401ks offer opportunities to grow your investments tax-deferred or tax-free. Be mindful of these factors when building and adjusting your portfolio. 9. In summary, asset allocation is a crucial strategy for managing risk and achieving your financial goals. By dividing your portfolio among different asset classes and regularly rebalancing, you can create a balanced and diversified portfolio that aligns with your investment objectives. In the next segment, we'll discuss the concept of dollar cost averaging and how it can benefit your investment strategy. Dollar cost averaging. Finally, let's discuss dollar cost averaging, a simple yet effective investment strategy that can help mitigate the impact of market volatility. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the market price. This approach reduces the risk of making poor investment decisions based on short-term market movements and helps build wealth over time. Here's how dollar cost averaging works. Instead of trying to time the market and invest a large sum all at once, you invest a smaller, consistent amount regularly, such as monthly or quarterly. By doing so, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can lower your average cost per share and reduce the impact of market volatility on your portfolio. For example, let's say you decide to invest $200 every month in a mutual fund. In January, the fund's price is $10 per share, so you buy 20 shares. In February, the price drops to $8 per share, allowing you to buy 25 shares. In March, the price rises to $12 per share, and you buy 16.67 shares. Over time, this strategy can help you accumulate more shares at a lower average cost. Dollar cost averaging offers several benefits. First, it encourages disciplined investing. By committing to invest a fixed amount regularly, you build a habit of saving and investing, which can lead to long-term financial growth. It also helps take the emotion out of investing. Rather than reacting to short-term market fluctuations, you stick to a consistent investment plan, reducing the likelihood of making impulsive decisions. Another advantage of dollar cost averaging is that it reduces the impact of market timing. Trying to predict market movements is notoriously difficult, even for experienced investors. By investing consistently over time, you avoid the pitfalls of trying to time the market and instead benefit from the market's long-term growth. Dollar cost averaging is particularly beneficial during periods of market volatility. When markets are down, your fixed investment amount buys more shares, taking advantage of lower prices. When markets are up, you buy fewer shares, but your existing shares appreciate in value. This strategy can smooth out the ups and downs of the market and provide a more stable return over time. It's important to note that dollar cost averaging doesn't guarantee a profit or protect against loss. It's a long-term strategy that requires patience and discipline. Over time, however, it can help you build a diversified portfolio and reduce the impact of market volatility on your investments. One key consideration when implementing dollar cost averaging is to choose investments that align with your financial goals and risk tolerance. Whether you're investing in stocks, bonds, mutual funds, or ETFs, make sure your investment choices are part of a well-diversified portfolio. In summary, dollar cost averaging is a straightforward and effective investment strategy that involves investing a fixed amount of money at regular intervals. This approach helps mitigate the impact of market volatility, encourages disciplined investing, and reduces the risks associated with market timing. By consistently investing over time, you can build wealth and achieve your long-term financial goals. That's it for our discussion on building your investment strategy. We've covered assessing your financial goals and risk tolerance, the importance of diversification, asset allocation strategies, and dollar cost averaging. Each of these components plays a crucial role in creating a successful investment plan. Stay tuned for the next segment, where we'll dive deeper into specific investment types and strategies to help you navigate the financial markets. 1. Deep dive stock investing. How to research stocks. In this segment, we're diving deep into stock investing, starting with how to research stocks. Proper research is crucial for making informed investment decisions and minimizing risks. Let's break down the essential steps in researching stocks. First, understand the company's business model. This involves looking at what the company does, its products or services, its target market, and its competitive advantage. Ask yourself, how does this company make money? A solid business model with a clear path to profitability is a good sign. Next, evaluate the company's financial health. Look at key financial metrics, such as revenue, earnings, profit margins, and cash flow. Increasing revenue and earnings over time indicate a growing company. Healthy profit margins suggest efficient operations, and positive cash flow indicates the company can cover its expenses and invest in future growth. Another critical aspect is the company's management team. Strong leadership can make a significant difference in a company's success. Research the backgrounds of key executives and board members. Look for a proven track record, relevant industry experience, and good corporate governance practices. Also, consider the industry and market conditions. A company's performance is often influenced by broader industry trends and economic factors. Analyze industry reports, competitive landscape, and market demand for the company's products or services. A company operating in a growing industry with high demand has better growth prospects. Examine the company's valuation. This involves determining if the stock is priced fairly based on its financial performance and growth potential. Common valuation metrics include the price to earnings, PE ratio, price to sales, PS ratio, and price to book, PB ratio. Comparing these ratios with industry peers can help you assess if the stock is overvalued, undervalued, or fairly valued. Pay attention to news and events. Stay updated on company news, earnings reports, product launches, and any other events that could impact the stock price. Significant news can influence investor sentiment and cause stock price fluctuations. Finally, consider the stock's historical performance. While past performance doesn't guarantee future results, it can provide insights into how the stock has reacted to different market conditions. Look at long-term trends rather than short-term fluctuations. Reading financial statements, Next, let's talk about reading financial statements, a crucial skill for evaluating a company's financial health and making informed investment decisions. There are three main financial statements to focus on: the income statement, the balance sheet, and the cash flow statement. The income statement, also known as the profit and loss statement, shows a company's revenues, expenses, and profits over a specific period, typically a quarter or a year. Key components include total revenue, cost of goods sold, COGS, gross profit, operating expenses, and net income. Revenue represents the total amount of money the company earned from its operations. COGS is the direct cost of producing the goods or services sold by the company. Gross profit is calculated by subtracting COGS from revenue, showing the profitability of the core business activities. Operating expenses include costs like salaries, rent, and marketing. Net income, also known as the bottom line, is the profit remaining after all expenses have been deducted from revenue. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It includes assets, liabilities, and shareholders' equity. Assets are what the company owns and are categorized as current or non-current. Current assets, such as cash and inventory, are expected to be converted to cash within a year. Non-current assets, like property and equipment, are long-term investments. Liabilities represent what the company owes, including current liabilities, due within a year, like accounts payable, and long-term liabilities like bonds payable. Shareholders' equity is the residual interest in the company's assets after deducting liabilities, essentially representing the owner's stake in the company. The cash flow statement tracks the flow of cash in and out of the company over a specific period. It's divided into three sections: operating activities, investing activities, and financing activities. Operating activities show the cash generated or used by the company's core operations, providing insights into its ability to generate cash from its regular business activities. Investing activities include cash flows related to the purchase and sale of long-term assets like property and equipment. Financing activities show cash flows related to borrowing and repaying debt, issuing or repurchasing stock, and paying dividends. Understanding these financial statements is crucial for assessing a company's financial health. Look for trends in revenue, expenses, and net income on the income statement. Consistent growth in revenue and profits indicates a healthy, growing company. On the balance sheet, ensure that the company has more assets than liabilities and a healthy level of shareholders' equity. On the cash flow statement, positive cash flow from operating activities is a good sign, indicating that the company generates enough cash to sustain and grow its operations. Value versus growth investing. Now let's explore two fundamental investing strategies: value investing and growth investing. Understanding these strategies can help you choose stocks that align with your financial goals and risk tolerance. Value investing focuses on buying stocks that appear undervalued based on fundamental analysis. Value investors look for companies trading below their intrinsic value, which is the actual worth of a company based on its earnings, dividends, and growth prospects. These stocks are often identified by low price to earnings, PE ratios, high dividend yields, and strong balance sheets. The idea is to buy these undervalued stocks and hold them until the market recognizes their true value, resulting in price appreciation. Key characteristics of value stocks include stable earnings, lower price volatility, and often a history of paying dividends. Value investors seek to buy these stocks at a discount, believing that the market has overreacted to short-term issues or overlooked the company's long-term potential. Famous value investors like Warren Buffett have popularized this strategy by achieving significant long-term returns through disciplined value investing. Growth investing, on the other hand, focuses on buying stocks of companies expected to grow at an above-average rate compared to the market. These companies typically reinvest their earnings into expanding operations, developing new products, or entering new markets rather than paying dividends. Growth investors are willing to pay a premium for stocks with high growth potential, betting on the future success of the company. Key characteristics of growth stocks include high earnings, growth rates, innovative products or services, and a strong competitive position in their industry. These stocks often trade at higher PE ratios due to their growth prospects. Growth investors are more focused on capital appreciation rather than income, seeking substantial returns through price increases over time. The choice between value and growth investing depends on your investment goals and risk tolerance. Value investing is often seen as a more conservative approach, focusing on capital preservation and steady returns. It's suitable for investors seeking stable income through dividends and lower volatility. Growth investing is considered more aggressive, suitable for investors willing to take on higher risk for the potential of higher returns. It's ideal for those with a longer investment horizon who can withstand short-term market fluctuations. Both strategies have their merits and can be successful if executed properly. Some investors prefer a blended approach, incorporating both value and growth stocks in their portfolios to diversify and balance risk. This strategy allows them to benefit from the stability of value stocks and the growth potential of growth stocks. 1. Beyond stocks. Other investment vehicles. Bonds and fixed income. In this segment, we'll explore investment vehicles beyond stocks, starting with bonds and fixed income. Bonds are debt securities issued by governments, municipalities, and corporations to raise capital. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of the bond's face value at maturity. There are several types of bonds. Government bonds, such as U.S. Treasury bonds, are issued by national governments and are considered low risk. Corporate bonds are issued by companies and typically offer higher yields but come with higher risk. Municipal bonds are issued by local governments and often provide tax-free interest income. Bonds are generally considered safer than stocks because they provide regular income through interest payments and the return of principal at maturity. This makes them attractive to conservative investors seeking stability and income. The interest rate, also known as the coupon rate, is fixed, providing predictable returns. However, bond prices can fluctuate based on changes in interest rates and the issuer's creditworthiness. One of the main risks associated with bonds is credit risk, the possibility that the issuer may default on interest payments or fail to repay the principal. Government bonds typically have lower credit risk compared to corporate bonds. Another risk is interest rate risk. When interest rates rise, bond prices fall, and vice versa. This is because existing bonds with lower interest rates become less attractive compared to new bonds issued at higher rates. Bonds are a key component of a diversified investment portfolio. They provide a counterbalance to the volatility of stocks, helping to stabilize overall returns. Investors nearing retirement or those with lower risk tolerance often increase their allocation to bonds to preserve capital and generate steady income. Real estate investment trusts, REITs. Next, let's talk about real estate investment trusts, or REITs. REITs are companies that own, operate, or finance income-producing real estate. They allow investors to invest in real estate without directly owning property, providing a way to earn income from real estate investments without the hassle of property management. There are several types of REITs. Equity REITs own and operate income-generating properties, such as apartment complexes, office buildings, shopping malls, and hotels. Mortgage REITs provide financing for income-producing properties through mortgages and loans. Hybrid REITs combine the characteristics of both equity and mortgage REITs, offering a diversified approach. REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This requirement makes REITs attractive to income-focused investors, as they provide regular high-yield dividend payments. Additionally, REITs are traded on major stock exchanges, offering liquidity and ease of access compared to direct real estate investments. Investing in REITs offers several benefits. First, they provide diversification, as they invest in a variety of properties across different sectors and geographic locations. This helps spread risk and reduce the impact of any single property's poor performance on the overall portfolio. Second, REITs offer the potential for capital appreciation as property values increase over time. Third, REITs provide a way to invest in real estate with lower capital requirements compared to buying properties directly. However, REITs also come with risks. The performance of REITs is influenced by factors such as property market conditions, interest rates, and economic cycles. For example, a downturn in the real estate market can negatively impact the value of REITs. Additionally, rising interest rates can make borrowing more expensive for REITs, potentially affecting their profitability and dividend payments. Exchange-traded funds, ETFs. Now, let's explore exchange-traded funds, or ETFs. ETFs are investment funds that trade on stock exchanges, similar to stocks. They hold a diversified portfolio of assets, such as stocks, bonds, commodities, or a combination, and aim to track the performance of a specific index, sector, or asset class. There are several types of ETFs. Equity ETFs track stock indexes like the S&P 500 or sectors like technology. Bond ETFs invest in a portfolio of bonds, providing fixed income exposure. Commodity ETFs track the price of commodities like gold, oil, or agricultural products. Additionally, there are specialized ETFs, such as those focusing on specific themes like clean energy, emerging markets, or dividend-paying stocks. One of the main benefits of ETFs is diversification. By investing in an ETF, you gain exposure to a broad range of assets, reducing the risk associated with investing in individual securities. ETFs also offer liquidity, as they are traded on exchanges like stocks. This means you can buy and sell ETF shares throughout the trading day at market prices. ETFs typically have lower expense ratios compared to mutual funds, making them cost-effective investment options. ETFs are also flexible investment tools. They can be used to implement various investment strategies, such as asset allocation, sector rotation, or hedging. For example, if you believe a particular sector will outperform, you can invest in a sector-specific ETF to gain exposure. Conversely, if you want to reduce risk in your portfolio, you can invest in bond ETFs or commodity ETFs. However, ETFs also come with risks. The value of ETF shares can fluctuate based on the performance of the underlying assets. Additionally, while ETFs offer diversification, they are not immune to market risks. For example, if the entire stock market declines, equity ETFs tracking the market will also decrease in value. It's essential to understand the underlying assets and the index or sector the ETF tracks to make informed investment decisions. Cryptocurrency, opportunities and risks. Finally, let's discuss cryptocurrencies, a relatively new but rapidly growing investment vehicle. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate independently of a central bank. Bitcoin, Ethereum, and Ripple are some of the most well-known cryptocurrencies. One of the main opportunities in cryptocurrencies is their potential for high returns. Bitcoin, for example, has seen significant price appreciation since its inception. Early investors have made substantial profits, and the growing acceptance of cryptocurrencies as a legitimate asset class has attracted more institutional and retail investors. Cryptocurrencies also offer decentralization. They operate on blockchain technology, a distributed ledger that records all transactions across a network of computers. This decentralization reduces reliance on traditional financial institutions and can provide greater transparency and security. Additionally, blockchain technology has various applications beyond digital currency, such as smart contracts and decentralized finance, DeFi, which have the potential to revolutionize industries. Another benefit of cryptocurrencies is their accessibility. Anyone with an internet connection can buy, sell, and trade cryptocurrencies on various exchanges. This accessibility opens up investment opportunities to a global audience and provides an alternative to traditional financial systems, especially in regions with limited access to banking services. However, cryptocurrencies also come with significant risks. One of the main risks is volatility. Cryptocurrency prices can fluctuate dramatically over short periods, leading to substantial gains or losses. This volatility can be challenging for investors to navigate and requires a high tolerance for risk. Regulatory risk is another concern. Governments around the world are still determining how to regulate cryptocurrencies. Changes in regulations can impact the value and legality of cryptocurrencies, potentially affecting their adoption and market stability. Investors must stay informed about regulatory developments and be prepared for potential changes. Security is also a critical issue. While blockchain technology is secure, cryptocurrency exchanges and wallets can be vulnerable to hacking and fraud. Investors must take precautions to protect their assets, such as using secure wallets, enabling two-factor authentication, and being cautious of phishing scams. In summary, cryptocurrencies offer high return potential, decentralization, and accessibility, making them an attractive investment for some. However, they also come with significant risks, including volatility, regulatory uncertainty, and security concerns. Understanding these opportunities and risks is crucial for making informed investment decisions in the rapidly evolving cryptocurrency market. That's it for our discussion on investment vehicles beyond stocks. We've covered bonds and fixed income, real estate investment trusts, REITs, exchange-traded funds, ETFs, and cryptocurrencies. Each of these investment options provides unique opportunities and risks, allowing you to diversify your portfolio and achieve your financial goals. Stay tuned for the next segment, where we'll discuss common investing mistakes and how to avoid them. 1. Common investing mistakes and how to avoid them. Emotional investing. In this segment, we'll discuss common investing mistakes and how to avoid them. Starting with emotional investing. Emotional investing refers to making investment decisions based on emotions rather than rational analysis. Common emotions that influence investing include fear, greed, and overconfidence. Fear can lead to panic selling during market downturns. When the market experiences a decline, it's natural to feel anxious about your investments losing value. However, selling in a panic can lock in losses and prevent you from benefiting from potential market recoveries. To avoid this, have a long-term investment strategy and stick to it. Remember that markets are cyclical and downturns are often followed by recoveries. Greed, on the other hand, can lead to chasing high returns without considering the risks. During a bull market, it's easy to get caught up in the excitement and invest in overvalued assets, hoping for continued high returns. This can result in buying at the peak and suffering losses when the market corrects. To avoid this, focus on the fundamentals of your investments and maintain a diversified portfolio. Overconfidence can result in taking excessive risks, believing one's judgment is infallible. This can lead to a lack of diversification and overexposure to high-risk investments. It's important to recognize the limits of your knowledge and not rely solely on gut feelings. Base your investment decisions on thorough research and analysis. One effective way to mitigate emotional investing is to automate your investments. Setting up automatic contributions to your investment accounts and using strategies like dollar-cost averaging can help you invest consistently without letting emotions dictate your decisions. Automation can also ensure that you stay on track with your financial goals regardless of market conditions. Another strategy is to stay informed, but avoid reacting to short-term market noise. Regularly review your investment portfolio and performance, but avoid making impulsive decisions based on daily market fluctuations. Focus on your long-term financial goals and maintain a disciplined approach to investing. Lack of patience. Next, let's talk about the importance of patience in investing and the common mistake of lacking it. Investing is a long-term endeavor, and successful investors understand that it takes time for investments to grow and compound. Impatience can lead to short-term thinking and frequent trading, which may erode returns due to transaction costs and taxes. One of the key principles of successful investing is the power of compound interest. Compounding occurs when the returns on your investments generate their own returns over time. This process accelerates your wealth growth, but it requires patience to realize its full potential. By staying invested for the long term, you allow compounding to work in your favor. Impatience can lead to market timing, where investors try to buy low and sell high based on short-term market movements. Market timing is notoriously difficult, even for experienced investors, and can result in missing out on significant gains. Studies have shown that missing just a few of the best-performing days in the market can drastically reduce overall returns. To cultivate patience, focus on your long-term financial goals and ignore short-term market fluctuations. Develop a well-thought-out investment plan and stick to it, regardless of market volatility. Regularly review your investment strategy to ensure it aligns with your goals, but avoid making changes based on short-term market noise. Another strategy is to diversify your portfolio. Diversification can help reduce the impact of volatility on your overall portfolio, making it easier to stay patient during market downturns. By spreading your investments across different asset classes, sectors, and geographic regions, you can smooth out the ups and downs of the market and maintain a more stable return over time. Automating your investments can also help you stay patient. Setting up automatic contributions to your investment accounts ensures that you consistently invest over time, regardless of market conditions. This disciplined approach can help you avoid the temptation to make impulsive decisions based on short-term market movements. Lastly, educate yourself about investing and the benefits of a long-term approach. Understanding the historical performance of the markets and the principles of compounding can reinforce the importance of patience. Reading books, taking courses, and following reputable financial news sources can help you build confidence in your investment strategy and stay focused on your long-term goals. The importance of continual learning and adapting. Finally, let's discuss the importance of continual learning and adapting in your investment journey. The financial markets and economic landscape are constantly evolving, and staying informed is crucial for making sound investment decisions and achieving long-term success. One way to stay informed is by reading books, articles, and research reports on investing and personal finance. Books by renowned investors, such as Warren Buffett, Peter Lynch, and Benjamin Graham, provide valuable insights into investment strategies and market behavior. Financial news websites, investment blogs, and research reports from reputable sources can also help you stay updated on market trends and economic developments. Taking courses and attending seminars or webinars on investing can enhance your knowledge and skills. Many universities and online platforms offer courses on various aspects of investing, from basic concepts to advanced strategies. Attending seminars and webinars hosted by financial experts can provide practical insights and allow you to learn from experienced professionals. Joining investment clubs or online communities can be a great way to exchange ideas and learn from other investors. These groups provide a platform to discuss investment strategies, share experiences, and stay informed about market developments. Engaging with a community of like-minded individuals can help you stay motivated and continuously improve your investment approach. It's also important to regularly review and analyze your investment portfolio. Assess the performance of your investments and make adjustments as needed to ensure they align with your financial goals and risk tolerance. Stay flexible and be willing to adapt your strategy based on changing market conditions or personal circumstances. Monitoring economic indicators and market trends can help you make informed decisions. Key indicators such as GDP growth, unemployment rates, inflation, and interest rates provide insights into the overall economic environment. Understanding these indicators and their impact on the markets can help you anticipate potential changes and adjust your investment strategy accordingly. Another crucial aspect of continual learning is understanding new investment opportunities and emerging trends. For example, the rise of cryptocurrencies, ESG, environmental, social, and governance, investing, and technological advancements in fintech are shaping the future of investing. Staying informed about these trends can help you identify new opportunities and stay ahead of the curve. Working with a financial advisor can provide additional guidance and support. A professional advisor can help you develop a comprehensive investment plan, provide personalized advice, and keep you informed about market developments. Regularly consulting with your advisor can help you stay on track and make necessary adjustments to your strategy. In summary, continual learning and adapting are essential for successful investing. By staying informed through reading, courses, seminars, and communities, regularly reviewing your portfolio, monitoring economic indicators, and exploring new opportunities, you can make informed decisions and achieve long-term financial success. Embrace a mindset of continuous improvement and stay proactive in your investment journey. That's it for our discussion on building long-term wealth. We've covered the power of compound interest, retirement accounts, and tax-advantaged investing, creating passive income streams, and the importance of continual learning and adapting. By implementing these strategies, you can build a solid foundation for long-term financial success. Stay tuned for the conclusion of our video, where we'll recap the key points and provide actionable steps to start your investment journey today. Recap of key points. Welcome to the conclusion of our video, Master the Art of Investing, your roadmap to long-term wealth in 2024 and beyond. Let's recap the key points we've covered to help you on your investment journey. First, we explored the foundations of investing, understanding what investing is, the different types of investments like stocks, bonds, and real estate, and the crucial concept of risk versus reward. We emphasized the importance of knowing the basics to build a solid foundation for your investment strategy. Next, we delved into understanding the financial markets, learning how stock markets work, the economic factors that affect investments, and the differences between bull and bear markets. This knowledge helps you navigate market fluctuations and make informed decisions. We then discussed building your investment strategy by assessing your financial goals and risk tolerance, understanding the importance of diversification, asset allocation strategies, and the concept of dollar-cost averaging. These strategies are essential for managing risk and optimizing your investment portfolio. In our deep dive into stock investing, we covered how to research stocks, read financial statements, and the differences between value and growth investing. This section provided you with the tools to evaluate stocks and make sound investment choices. Beyond stocks, we explored other investment vehicles such as bonds, real estate investment trusts, REITs, exchange-traded funds, ETFs, and cryptocurrencies. Understanding these options helps you diversify and enhance your investment portfolio. We also highlighted common investing mistakes and how to avoid them, including emotional investing, lack of patience, neglecting to rebalance, and trying to time the market. Recognizing and avoiding these pitfalls can improve your investment performance. Finally, we discussed building long-term wealth through the power of compound interest, retirement accounts, and tax-advantaged investing, creating passive income streams, and the importance of continual learning and adapting. These strategies are key to achieving long-term financial success. Call to action. Steps viewers can take today to start their investment journey. Now that you have a comprehensive understanding of investing, here are some actionable steps you can take today to start your investment journey. 1. Set clear financial goals. Define your short-term, medium-term, and long-term financial goals. 1. Be specific about what you want to achieve and set a timeline for each goal. 2. Assess your risk tolerance. Evaluate your comfort with risk based on your financial situation, investment time horizon, and personal preferences. 2. This will help you determine the right mix of investments for your portfolio. 3. Create a budget and save. Establish a budget to manage your expenses and identify areas where you can save more money. 3. Use these savings to fund your investments. 4. Educate yourself. Continuously learn about investing by reading books, taking courses, and following reputable financial news sources. 4. Stay informed about market trends and economic developments. 5. Open an investment account. If you don't already have one, open a brokerage account, retirement account, or other investment accounts that suit your needs. 5. Many online platforms offer user-friendly interfaces and low fees. 6. Start investing regularly. Begin investing a fixed amount of money regularly, using strategies like dollar-cost averaging. 6. This disciplined approach helps you build wealth over time and reduces the impact of market volatility. 7. Diversify your portfolio. Spread your investments across different asset classes, sectors, and geographic regions to reduce risk and enhance stability. 8. Review and adjust your portfolio. Regularly review your investment portfolio to ensure it aligns with your goals and risk tolerance. 8. Make adjustments as needed based on market conditions and changes in your personal circumstances. 8. Thank you for joining us on this comprehensive journey into the world of investing. But our learning doesn't stop here. In our future videos, we'll dive deeper into specific investment topics to enhance your knowledge and skills. Upcoming videos will cover advanced investment strategies, sector-specific investing, understanding financial derivatives, and how to leverage technology in your investment process. We'll also explore topics like socially responsible investing, the impact of global events on markets, and much more. Stay tuned and make sure to subscribe to our channel so you don't miss out on these valuable insights. Hit the notification bell to get updates on our latest content. Together, we'll continue to build our knowledge and achieve financial success. Remember, investing is a journey, not a destination. By staying informed, disciplined, and proactive, you can navigate the financial markets with confidence and achieve your long-term financial goals. See you in our next video.